Right, so I think we can start. So welcome everyone to this new event of the webinar series organized by the EAccess Forum on Climate Change, Macroeconomics and Finance. My name is Emanuele Campiglio. I'm an associate professor at the University of Bologna, and I will be chairing this event. So the aim of the forum in general is to aggregate researchers and policymakers working on topics at the intersection between climate, macroeconomics, and finance. There is this webinar series ongoing, but also there is a forum on Slack. There you will find working papers, news, conference information, and of course, information about this series of events. So the webinar series has by now hosted a number of different researchers offering multiple perspectives on these topics. We had a variety of methodological approaches. We had econometrics, we had macroeconomic modeling, we had policy analysis. I think today's speaker adds another arrow in our quiver, as we will deep dive in history, governance, and institutional analysis. So let me introduce you to our speaker, who is Jens van Klooster. I hope my pronunciation is good enough for our Dutch friends. So Jens is a postdoctoral fellow at the Institute of Philosophy of the KU Leuven and a member of the research group, A New Normative Framework for Financial Debt at the University of Amsterdam. So Jens have recently written a number of academic papers, somewhere between normative political philosophy and political economy on central banks in general, and then more specifically on their role in the climate change debate. So today he will give a talk entitled The ECB's Financial Risk Management, Historical Insights for the Review of the Monetary Policy Strategy. The event will be structured as follows. So Jens will have the floor for about 30-35 minutes, and then we will open the floor for questions. Please feel free to pose your questions in the chat during his presentation. If these are immediate clarification questions, then I will briefly interrupt Jens for him to address these questions. Otherwise, I will postpone everything to the Q&A section at the end of his talk. At that point, you will have two options. You can raise your hand and pose the question or make your comment directly to the speaker, or I can do it on your behalf. Both are fine. So before leaving the floor to Jens, please let me remind you that the event will be recorded, and let me launch the usual poll that you can now see here. So we have two questions, as usual, to see what the mood of the audience is concerning the topics of the seminar. So the first question is, should financial stability and environmental protection always remain subordinate to price stability in monetary policy? And the second question is, should central banks rely on private credit rating agencies for the implementation of monetary policy? Please take a few seconds to think about it and to answer, and then we will have access to the results. Right, so interesting results. So the first question sees the audience quite divided between the yes and the no. Of course, the questions are quite general and ambiguous, so maybe we will have some more details during the Q&A on this. And should central banks rely on private credit rating agencies? I would say that the result is overwhelmingly no, although there's a good degree of don't knows and yes. So yes, with these results in mind, I will now give you the floor, and thank you for being with us.
Yeah, thanks a lot. And very interesting results, because I will indeed caution against over-reliance on credit ratings. Of course, at the moment, still a really core of monetary policy, at least as it's implemented at the ECB. Okay, let me briefly put up my slides and then we can get going. Yeah, so the topic I will present on today is the ECB's financial risk management, historical insights for the review of the monetary policy strategy. What I'm going to do, wait, let me just put them up entirely, is I'm gonna build on a larger research project that I recently completed as a PhD on the politics of central bank risk management, which really sketches a longer historical story about how the ECB has related to financial risk in its history. And I'm going to build on that to provide, as the title puts it, historical insights for the review of the monetary policy strategy. So how can we build on that history to think about the challenges that the ECB currently faces and how to navigate them? Okay, so this project itself is really archive, interview-based historical research, talked with a lot of people involved in that history, a lot of documents, also did some more archival requests to the ECB to better understand how the ECB's risk management strategy evolved, and particularly also how decisions were made on how to deal with risk, and in that sense, the politics, the political economy of risk management. And then today, I'm going to build on that to draw out lessons for the current review. Now, the core of what I'm going to argue today is that the ECB has for a long time treated risk management as a technical issue. And I think this has had two really core objectives. On the one hand, avoiding losses, right? So in implementing monetary policy, doing that in such a way as to minimize the potential of financial losses. And of course, the very nature of monetary policy is that there is always financial risk because you are interacting with private sector counterparties. They can default. In that sense, risk is always there, but can be minimized. And then a second and closely related objective is that of market neutrality. So while implementing monetary policy and trying to minimize risk, otherwise avoiding having direct impact on relative prices through the way in which monetary policy is implemented. And my claim today is that the ECB also in this review should very seriously consider revising that perspective. So thinking about risk management, not just about a matter of avoiding losses and minimizing the impact on markets, but seeing risk management itself as a policy tool, because I think risk management is a policy tool. And once you see it that way, you also see immediately that it could be used more effectively going forward to support broader objectives of the ECB. Okay, so what is risk management? Now, as I said, monetary policy exposes the central bank to financial risk, but the nature of that risk depends, of course, on the different operations, and hence risk management differs between operations. Before 2008, the monetary policy of the ECB was almost entirely a matter of open market operations with bank counterparties providing short-term credit, and by that means steering interest rate in money markets. And on these kinds of operations, the risk is really determined by the collateral framework. So for ECB counterparties to access monetary policy credits. They need to put up collateral, post assets that the ECB acquires in the event of counterparty loss. And through the use of collateral, risk is really minimized to that of a double default. So first, the counterparty has to default, and then it also has to be the case that the asset that was pledged as collateral loses value. Now, the first observation to make about these operations and the risk on them is that counterparties do not default frequently. In fact, in the whole history of the ECB, there were 5 defaults, 3 Icelandic banks, a very, very small Indonesian bank that was a subsidiary of the Indonesian central bank operating in the Netherlands. And then, of course, Lehman Brothers, by far the largest default, 8.5 billion default in 2008. To be precise, Lehman Brothers Kaufhaus AG in Frankfurt defaulted on its credit to the Bundesbank. And then, interestingly enough, once the Bundesbank started digging into the collateral, turned out it was actually not so good collateral. There was a lot of ABSs, very complex, very intransparent, names like Destiny, Ruby, and in the end, it took until 2014, if I'm correct, to really sell off those assets. So they had to be repackaged, in the end could be sold off. In the end, also not with any losses, but that could take some while. But at least it's clear here that risks are managed quite effectively by high quality collateral, and then that was always a relatively simple task. Now, in response to the crisis, of course, monetary policy has evolved considerably, most strikingly within the asset purchase programs. And these are, from a risk management perspective, entirely different creatures, because, of course, if you buy an asset, you are directly exposed to financial risk. And for a loss the size of the Lehman Brothers default, 8.5 billion to happen on the existing asset purchase programs, it's clear that only a few basis points of the existing portfolio have to lose value. Now, this is one perspective on risk management, where we think about minimizing losses, and where in some ways the central bank acts very much like a private sector entity. But I want to emphasize a second perspective that I think is at least equally important, closely related to the idea that it's a policy tool, which is that risk management shapes financial markets. So the way in which a central bank manages risk is in some ways not at all like a private sector counterparty, because the central bank has such a pivotal role in the financial system that the way in which it deals with risk has all sorts of knock-on effects, also shapes the development of financial markets. There's broadly 2 main channels via which risk management shapes financial markets. The first is just a basic demand and supply effects, right? 2.5 trillion in collateral pledged at the Euro system, 3.7 trillion in outright purchases. Of course, it matters what the central bank buys or doesn't buy for the way in which prices operate in the market. And then the second is a more structural effect, namely that counterparties prefer eligible assets, because an asset that's eligible at central bank can be converted into cash at short notice. And also because of this pivotal role, private sector counterparties copy central bank risk management practices. Just so over and beyond these basic demand and supply effects, the key role of the central bank in the financial system gives even more effect to the choices it makes. This also means that because it has these effects, central bank can use risk management to achieve policy objectives. And here the Lehman Brothers default also gives a very interesting example, because after the default, the ECB launched a so-called loan level initiative, where as a condition for posting ABSs at the collateral framework, a range of disclosure requirements were put in place. And this then, of course, also spread from monetary policy operations to private sector repo transactions. So just by the way in which the ECB changed its risk management practices in relation to ABSs, also made the ABS market more transparent, which is not just relevant for ECB risk management purposes. Okay, so what am I going to do today? My talk has three parts. First, I'm going to look at these early debates on the collateral framework, debates that happened largely before 2008, and the approach to risk that results from that, in which risk management is not at all treated as a policy tool. Then I'm going to look at the Eurozone crisis and the climate as two more recent challenges in which I think you really see that the way in which the ECB now relates to risk counteracts other objectives that it has. So that because the way in which it manages risk is too much still that of a private sector entity, that risk management doesn't optimally support the objectives of the ECB itself. And then the third part, I'm going to sketch ways to use risk management as a policy tool. So how I think that works in practice and how that fits into the broader democratic questions you might also have on this. Okay, so the early debates. And this is largely based, you see that here already, on documents that came from the archives and that give you a really fascinating insight into debate in the early 90s on risk management. Okay, so where does the story start? Of course, the story starts with the Maastricht Treaty, decided in 1992, where you find the mandate of the ECB. And interestingly enough, where it comes to risk management, the mandate is just very, very vague. It contains very general provisions concerning ECB operations. In the statutes, there is a very general permission to purchase any claims and marketable instruments, whether in euro or other currencies, as well as precious metals. So basically, you can buy almost anything. And then a second provision that allows lending subject to adequate collateral. And of course, again, there's no further explanation what adequate collateral consists in. And this results from the politics in the Maastricht Treaties, of course, a intergovernmental treaty. The earlier Delors committee, you see Delors here on the picture with the football, doesn't really go into detail on some of these topics, although it does on a lot of others. And that means that actually when the Euro project starts, very few of this has been decided, and most things are really set up at the European Monetary Institute. So the precursor of the ECB, where between 1994 and 1998, really the outlines of the operational framework are decided. Okay, so collateral, turns out, is a really difficult topic there. So already at one of the first meetings on this topic, and I just put the quote up here, the relevant working group, which I went through the notes for, they already signaled this is a highly sensitive and difficult task. So deciding what should be collateral for the ECB, because decisions may themselves influence prices and risk premia on markets, and may affect the views of private agents on the quality of assets deemed available. So already very much in line with what I said earlier, that the risk management will shape financial markets. Now, the second thing that makes it difficult is that the different national central banks in the Euro system deal with risk in very different ways. So there are broadly three groups, and I think the graph sort of shows this quite well. First, there is a group of central banks that just accept public sector assets. Denmark, Spain, Ireland, Italy, Portugal. This is a set of operational practices where any collateral is a public sector entity. Now, then there is a second group which is somewhat similar, but also accepts a range of marketable assets, often subject to a credit rating requirement, also a very diverse range of assets. And then third, and I think this is that's for example the Netherlands, United Kingdom. Actually, I think the third group is the most interesting, namely central banks, particularly Germany, France, and Austria, that accept public debt, but that also have large internal credit rating facilities for bank loans. So banks can pledge otherwise not marketable loans at the central bank as collateral, and these internal credit ratings have quite an important systemic role in those financial systems. Banque de France to this day visits 40,000 companies each year to provide them with ratings. And the outcome of this is disagreement, maybe initial decision is made to not focus just on public debt, but then there's a host of other choices. So what do you accept, what do you not accept? And basically this working group, it ends slightly apparatically. There's no agreement. And what comes out instead is the so-called two-tiered system in which every national central bank has its own collateral framework. So there is, on the one hand, a first-tier system, as you would expect, right? So the collateral framework of the ECB itself, that is quite selective. It has to be a debt instrument. It has to have a public credit rating, and on loans issued against collateral from that list, there is risk sharing. So any losses are shared within the euro system as a whole, rather than the individual central bank who gave out credit. But there is also a set of second-tier lists, which every NCB can decide on itself. And here, central banks quickly, increasingly add more exotic assets, with the argument that they are really important to their domestic financial system. For example, the Dutch central bank, they put up shares traded on the AEX. Now, that is a decision that the national central banks make, and then also the idea is no risk sharing on those assets. Okay, now over time there is discontent with this system. First, just the idea that as a part of European integration, the collateral framework should be harmonized, but also two more concrete objections. So first, there's a worry that as it is at that point, there's not really a transparent criterion for eligibility in tier one, right? There's the requirement of high credit quality standards, but how that actually is then evaluated, certainly for government debt, is until that point unclear. But more importantly, the NCBs use these tier two lists to benefit their own banks. They create niches, right? You can imagine AEX here, a Spanish bank is not going to have those assets. And in this way, also you undermine the level playing field. So what then happens in the course of the 2000s is the creation of the single list, a much more technical approach to risk, and strict rules to harmonize the collateral framework. Specifically, more use of private credit ratings, and also then a assessment for which sources of credit evaluation to use. Now, this solves the earlier discussion where you had all these different practices at the different NCBs because they all fit into this system, right? So on the one hand, you get a whole range of marketable private sector assets that are eligible, but also, interestingly, the credit rating facilities of the national central banks are slotted into this system. So also the Bundesbank and the Banque de France credit rating facilities are today evaluated every year as part of the single list to see whether their ratings are sufficiently accurate to serve in the collateral framework. Okay, so how does this work in practice? And this is basically the system that's still the foundation of the ECB's risk management strategy. You get a system that has two key criteria. On the one hand, one of minimizing risk, so risk efficiency, and particularly, right, a minimum credit rating threshold that determines which assets are sufficiently safe. But in addition to that, a criterion of market neutrality, right? Rather than all these debates over whose assets should be pledged and when, the idea is a whole scala of private sector, public sector, marketable, non-marketable assets should all be eligible under similar conditions, and the ECB should avoid taking a stance between these different assets. Now, in practice, as I said, this involves a combination of external and internal credit ratings, private credit ratings, external providers for public debt. And in this discussion, the assertion becomes very prominent that risk management is not a policy tool. Lucas Papademos in 2005 even suggests that using the framework for alternative purposes would be contrary to the ECB's mandate. And I will get back to this, but I think this is not true. Okay, so this is broadly the framework, and there is really some historical irony. This comes into force in 2007. Basically, a few months later, the global financial crisis starts. Okay, now, what I now will zoom in more detail is the aspects of risk management as they function in the years that follow, and some of the ways in which it becomes clear that the risk management strategy really has unintended effects on financial markets. On the one hand, in the Eurozone crisis, on the other hand, in relation to the climate. And I think these two stories share a very similar objection to risk management as it currently takes place. As I said, central banks' risk management does not just follow markets, but it also shapes them. And this means that a risk management strategy that follows markets also enforces its dynamics, right? So if you shape markets, but you follow the market, then you make the market dynamics that are already there even stronger. Now, that is desirable, of course, when markets price risk accurately, but it also enforces pro-cyclical dynamics and market failures. And I think both the examples that I highlight illustrate that point quite well. So first, pro-cyclicality of risk management in Eurozone crisis. I think there, the core dynamic is one of rising spreads between Germany, core of the Eurozone on the one hand, and a number of member states more at the periphery of the Eurozone, where you see large loss of value of that debt, so rising yields on those bonds and self-enforcing dynamics, right? So given that the interest rates are going up, it becomes more difficult to repay the debt, the risk of defaults go up, even more sales of the bonds, risk go up, also as a result of decreasing value of the bonds, losses for the banks, right? The doom loop between banks and governments. Banks make losses because of rising spreads, lower value of the bonds. At that point, the chance that governments need to bail out the banks also increases. And I think these dynamics are fundamentally a financial market dynamic, right? There's no underlying risk of default that goes up in the period between 2008 and 2011 that really can explain these spreads. Fundamentally, it's a financial market dynamic. And part of that dynamic is about risk management practices in the private sector and also in the ECB. So the value of sovereign debt goes down, in part because higher haircuts, right? So lower value of the assets as collateral, and also because the future value of sovereign debt as collateral is unclear, right? If it's possible that the credit ratings will drop so far that they can no longer be used as collateral, then of course that is itself a reason to sell the asset. Now, in these ways, the risk management of the ECB interacts very clearly and enforces some of the pro-cyclical dynamics you see in the Eurozone crisis. Now, it's true that the ECB issues waivers, right? So say we will continue to accept these assets as eligible, although your credit rating is currently not sufficient to be eligible. But of course, the conditions under which these are provided are discretionary, so provide very little in the way of guarantees going forward. Okay, so that I think is one clear example where the way in which ECB risk management followed private credit ratings and market dynamics enforced the dynamics of the Eurozone crisis. The other example, and I think you'll see the striking structural similarity is the climate, right? And particularly the failure to adequately price climate risk. Now, at the moment, capital markets do not adequately price climate-related risk. This is on the one hand because there are no disclosures, right? There's no very limited disclosures from companies regarding the sort of risks they face from investors, and that means that these sort of factors, which we know exist, should impact the value of assets, are currently just not accurately priced in. Also, we know, as a consequence of the Paris Agreement, that things are going to happen, right? There is going to be all sorts of transition efforts to do away with certain industries, but these decisions haven't been made concretely. The externalities of these business models in that sense have not been priced in and are therefore currently also not reflected in financial market prices. And the way in which the ECB currently manages risk in relation to climate change, again, enforces these market failures, right? So on the one hand, and this is by now quite an infamous example, that the corporate bonds that are part of the CSPP tend to be concentrated specifically at multinational corporations with ample collateral, and these multinationals with ample collateral that fund themselves in bond markets, and as the graph I think well illustrates, is that it's just specific sectors that are operating that rely heavily on bond markets, that can fund themselves in bond markets, and for that reason, particularly older business models, fossil fuel intensive business models, are overrepresented in the bond market and hence in ECB asset purchase programs, also in ECB collateral, right? So the collateral framework and the CSPP follow very similar rules. So the disproportionate reliance on fossil fuel intensive issuers in the CSPP also reflected in the collateral criteria. And the second is, of course, that credit ratings are based on historical data. Climate change hasn't occurred yet. Historically, a lot of fossil fuel economy has been very profitable, so that's still looks very good on historical data, but going forward, of course, maybe not. Now, and I think what's interesting, maybe if I gave this talk a year ago, this would have been sort of the end of the story, but it's also clear that this is now very much on the agenda at the ECB. On the one hand, I think past year you've seen all the collateral easing measures, which are also explicitly motivated by counteracting adverse pro-cyclical feedback effects. On the other hand, of course, as everybody on this call will probably be aware, climate market failures are really a priority in the strategic review. And how I would sketch this development historically is that this is really thinking about risk management more as a policy instrument and seeing that it can be used to pursue financial stability and environmental objectives. Okay. How much time do I still have, Emmanuel? I don't want to go dramatically over time.
No, I think we're fine. Maybe if you could finish in 5 minutes, if that's okay with you.
Yeah. Then I'll just briefly go through how I think, also based on this history, the risk management can be used as a policy tool. Now, the first observation is that the ECB mandate provides really good reasons to take both pro-cyclicality and climate change very seriously, right? So first point, just really pursuing sustainable price stability, right? So doing, making sure that the EU economy develops in a gradual way without overinvestment in sectors that need to be written off in a few years from now, avoiding a crisis. There's just very clear reasons why one of the preconditions for sustainable price stability is, on the one hand, avoiding pro-cyclical dynamics in bond markets, on the other hand, also having an eye to climate change. I personally am also very interested in the secondary mandate. So the secondary mandate is like the primary mandate for price stability. It's in the same article as the price stability objective. It is without prejudice to price stability. So only, as the question we started it with this session already mentioned, if looking at the climate, if looking at financial stability doesn't go to the detriment of price stability, but they are clearly objectives in their own way, namely to support the general economic policies in the unions. More specifically, also one of these objectives to contribute to a high level of protection and improvement of the quality of the environment, right? So also really specifically mentioning climate change. And I think as Frank Elson recently very correctly put it, these are not optional things, right? They are a duty just like price stability. Okay, same is true for financial stability. Article 127.5 just says this is an objective of the ECB. But it's not so simple what to do with these objectives. And I think really the crucial challenge is how to contribute to these objectives. So it's not a question whether, but how. And that's, of course, not in the mandate. This week in Le Monde with colleagues, we had an op-ed where we say, look, you really have to take the secondary mandate seriously, but also to do that, you need more interaction with political institutions of the EU. And I'll tell you now in a bit more detail how I think to walk this dynamic, right? So on the one hand, being a central bank that is not itself a political institution, on the other hand, tasked with supporting some of these objectives, also having these objectives as a precondition for the primary objective. Okay, now the first, I think, is to revise the risk management strategy itself. So I think the narrow focused that I've outlined in terms of avoiding losses and market neutrality, that doesn't really represent what's in the mandate itself. And as I've shown, doing this can actually counteract some of the objectives that are actually in the mandate. And I think the way to do that is to move from market neutrality to market attentiveness. Clearly, avoiding losses has a role. Clearly, markets have a role in pricing financial assets and also in thinking about risk. But I think what market attentiveness requires is that ECB should verify whether market practices, as they are, really contribute to these secondary objectives and financial stability. And if not, then the monetary policy framework shouldn't be enforcing these market practices. So maybe the simplest way to do this in relation to climate is to say, well, we only accept assets that adequately disclose climate risk, right? So one of the core sources of market failure that's really internal to financial markets just require disclosures for eligibility. I think over time, you can also wonder whether issuers that do not have what I refer to as a 1.5 degree strategy, right? So really a business model, an incredible story, how they fit into the long-term trajectory of the EU, whether these should still benefit from eligibility in the ECB collateral framework. I think that's the interesting discussions to have on this point. Okay, so the first point is doing away with market neutrality. But then how? Now, I think part of this is quite technical. It just revolves about better credit rating facilities, doing credit assessment better, improving what is, at the end of the day, still quite technical task, namely getting risk management right. This is not easy. Climate risks are often fundamentally uncertain, right? We do not have historical data on the basis of which we can estimate all this risk. But that also means that really leaving this to the market is inefficient and unreliable, right? There are incentives in the market to underestimate risk. So here you need to take a more hands-on approach. Now, one thing I think should be very seriously considered is to really develop internal credit ratings facilities, which are similar in scope to Moody's and S&P that also really price risk. Already at the moment, there are 8 central banks that have internal credit rating facilities. Maybe also the ECB should have one. The second is to do a broader performance monitoring for credit rating agencies. So already the ECB monitors performance of the credit rating agencies with regard to how they predict losses. You can, of course, also look at other aspects of risk management. At the moment, this is something that the ECB does by itself. You might also wonder whether the NCB should not have a role in this. And I think there are clear synergies with banking supervision, which is also currently struggling with how to deal with these climate risks. Okay, so this I think is really a core central bank task. But then you might wonder, should the ECB do all of this by itself? And I think here really the answer is no. No, the ECB should not do this by itself. I think here it becomes very important to look very closely at the mandate what is in the mandate and what's not in the mandate. Now, this touches on a much broader issue, namely that today the ECB faces a whole range of challenges, but it lacks clear democratic guidance. This is not surprising. The ECB mandate is very old. But in a recent article with Nick de Boer, we look at this in a lot more detail, and we conceptualize this in terms of so-called authorization gaps. So to say that the ECB faces choices where what it does really has far-reaching consequences, but which the mandate provides no direction, right? Where it really doesn't tell you what should the ECB be doing. We've touched on these 2 examples. On the one hand, what should the ECB be doing in a sovereign bond market panic? Very unclear on the basis of the mandate. On the one hand, what the ECB has done in the Eurozone crisis in the end is to buy government bonds to stabilize markets, right? Also now recently with the PEPP. But of course, there are still, particularly in Germany, central bankers who say, no, this is not allowed by the mandate, prohibition of monetary financing. And really, right, I don't think that would be a right policy, but I do see that you can reasonably say on the basis of the mandate and how it was drafted that would be a real serious legal consideration. The same is true, I think, for environmental impact. Okay, so what's the solution? More coordination between the ECB and the political institutions of the EU. So really getting political institutions involved in providing more clarification on what the ECB should be doing in relation to these difficult topics, such as the climate, such as government bond markets. There are, in Article 125, there's still the option to revise the monetary financing prohibition. In another paper, I've also suggested that part of monetary policy could be based on the green taxonomy of the European Union, where the EU has issued this very detailed regulation which says this asset counts as green, that doesn't count as green. Building on some of these assets, these regulatory initiatives might help navigating authorization gaps, really saying, look, as a central bank, we cannot make all these choices, but the political institutions of the EU have issued these guidelines to tell us what currently the economic objectives in the EU are, and do monetary policy on that basis. Okay, so to conclude, the ECB has for a long time treated risk management as a technical issue, focusing on avoiding losses and market neutrality. But as I hope to show, central bank risk management is itself a policy tool. It affects stability in financial markets. It affects the broader development of the economy, particularly in relation to decarbonization. And I think the review of the monetary policy strategy is really the right moment to reflect on how to make better use of this policy tool in the future. Thank you for your time, and I really look forward to the questions.
Brilliant. Thank you so much, Jens. And there's a few questions already in the Q&A section. I would invite the participants to raise their hands. So there's a few questions from Enrico Bernardini, and then one from Noemi Berger, and one from Catherine Assenmacher. So Catherine, I will give you precedence because you were the first one to raise your hand. So please.
Okay, thank you. So thank you, Jens. Very nice presentation, and I really liked how you traced out how the collateral framework was set up. And I think that your conclusion that risk management is not a policy tool also has to be seen in the context of conventional and non-conventional instruments. So the moment you have simply the interest rate, then you can say, well, we set the interest rate and we want to achieve this monetary policy objective with the minimal risk on the balance sheet. The moment you come to the lower bound, of course, then things change. And I think that's something that has to be acknowledged, because in the beginning, this was new for every central bank, and it was not fully clear how you have to react to this change in the environment. And I think the more recent experience with the COVID crisis made very clear that also the collateral framework was expanded quite a bit. So this is kind of a reaction to this change in the risk management thinking, so to speak, about that. And now, of course, with the green issues, things are very much in flux. So you mentioned your Le Monde op-ed. There was contribution in the Financial Times that Mark Carney stumbled over greenwashing. So this is, of course, a risk in a situation where the green assets are not yet fully agreed and acknowledged. So, but overall, I really liked your thinking about the risk management framework, and maybe it's also kind of an endogenous thing. So maybe you can say something on how you think about that, because the moment the central bank says it accepts, say, sovereign debt of a specific debtor, this debtor is liquid. And you have this bubble element in there. So there is also, especially with a large central bank balance sheet, there is also kind of a risk in using risk management as a policy tool. Thank you.
Yeah, thanks.
Thank you very much. So sorry, Jens, to interrupt. So I will let you answer this specific question. In the meantime, whoever else desires to pose a question, please raise your hand, or otherwise I will just read your questions in a minute.
Yeah. Yeah, I think I agree with you that it became much more clearly political, much more difficult, certainly since 2008, right? That a lot of the choices have become much more visible. But I do think that this was always a bit true, right? So if you consider the CSPP, it's very clear that it's political, right? Because you're buying Shell bonds, they're on your balance sheet. But of course, if you have Shell as eligible collateral in your collateral framework, then it's maybe not per se on your balance sheet, but still you are also supporting that issuer, right? So I think also in earlier times, there was this political dimension. Now we've become, of course, much more attentive to, for example, the climate impact of the financial system. You might also wonder, were people sufficiently attentive to it 20 years ago, right? So I think it's an open question, right? Might be that we go back very much to implementation as it was in the mid-2000s. You might also think, no, it has now just become clear that the sort of choices you make always have this sort of impact, and maybe even if you can bring down the asset purchase programs considerably, you will still face quite difficult political choices. As I shown, right, they were also very strongly disagreeing on this in the 90s, and I think that was because also then the stakes were quite high. But broadly, I agree very much with what you've said, that for various reasons these issues have become more difficult, also in relation to now very large sovereign bond portfolio. But I don't know if we will ever go back to apolitical central banking as it was thought to exist before 2008. Probably some of this is here to stay, and the ECB should find a way to deal with these sort of questions that go beyond the narrow price stability objective.
Thank you, Jens. So I don't see any raised hands. No, sorry. So we have too many questions. Let me see how to do it. So maybe I can ask questions on behalf of Enrico and Noemi, and then give the floor to Jorge Murato, who raised his hand. Enrico Bernardini poses a number of different questions. So I'll try to see if I understand them correctly. If you could give brief answers, if possible, Jens. So the first question has to do with collateral shortage. So I think what he means is are these measures, greening collateral measures, relevant and effective at this moment? The second question has to do with credit rating agencies, pointing out that they do assess ESG risks at the moment. There is a lot of development in that area. So if you can consider the climate-related risks already integrated in the collateral framework of the ECB. And then a final question that has to do with disclosure. So he doesn't seem convinced about the argument of a lack of disclosure for market mispricing, but he points out that another argument could be the methodologies, the risk assessment methodologies that are still under development. Let me, if you don't mind, add another one, which is from Noemi Berger. She asks your opinion on the EU green bond standard, transition bonds, and in general, whether you think it's a good idea to introduce standards for energy-intensive firms to enter the climate-friendly market and to use KPIs related to sustainable behavior. So Jorge and Franz, please, I will give you the floor in the next round.
Yeah. Okay. Yeah. Thanks. So maybe let me answer some of Enrico's question also by just saying that I really agree with the direction of some of the initiatives that Noemi has mentioned, right? Green bond standards, part of the EU taxonomy, specifically, and I also thinking about KPIs for energy-intensive firms. I think that's really the direction that I am myself thinking in, more than, for example, asking credit rating agencies to do better with ESG risk. And the reason for this is what I briefly touched on: fundamental uncertainty, right? So I think credit rating agencies, their business model has always been revolving around risk, right? And specifically for companies, you have a lot of companies, you have a lot of historical data, and actually they do quite well. All the criticisms you can have, they do quite well in picking out companies that are going to default, what the probability for that is. But that is because you have this history that you can rely on. I think going forward, you really need to make choices, right? How you see the future. We do not have that sort of evidence to say, well, this is how governments are going to do their climate policies. This is how extreme weather is going to play out. And at that point, any choice you make also shapes financial markets, right? So there's a political dimension to this, in the sense that there's not a technical issue. You have to make a choice how you decide to see the future, because you do not have a method, scientific method to determine what that future is. And that means that you're also unavoidably going to have to make choices that go beyond just regulating the credit rating agency. That said, I think a lot of the initiatives that Noemi has mentioned are currently still quite not yet sufficiently developed in some regards. And I think there also central banks will probably just have to make their own choices a bit as well, right? So even if there's not a completely clear set of policies already developed at the EU level and at the member state level, I think some of the some industries, right, some companies, just clear they don't have a 1.5 degree strategy, right? They don't have a story on how they are going to fit in economic development in the coming 20 years. I think their central banks could already make some choices. Collateral shortage, I could go into that in a lot of detail, but that I don't think that that's an immediate issue. And then, yeah, as I said, I think current disclosures just are not enough to begin with. And I think methodologies are in part still under development, but given the nature, given that it's not a technical task, probably more is needed than just developing more methodology.
Thank you, Jens. So I would like to give the floor now to Franz Nauschnick to pose a question. Franz, I think you need to unmute yourself. Okay, so while this gets resolved, let me forward you another question that appeared on the Q&A window from Patrick Flynn. So thanks for this interesting presentation. With regards to your suggestion of central banks complementing credit rating agencies' role or taking over completely, what is your view on the implications for assets being included in asset purchases programs based off these ratings? So this is one question. Franz, are you with us? If you are, we can't hear you. So I will just let Jens answer this one, and then we will come back to you.
yes, I am in favor of that. I think you should also use credit rating facilities that you develop, really just looking at what sort of assets you will support. But I think there the issue comes out very clearly, right? If you start stock picking as a central bank, you do want to have a very clear basis of legitimacy for that, right? And I think it's certainly not desirable that stock picking happens on, personal views that board members of the individual NCBs happen to hold, or people that they might personally know, right? I think it's clear to everyone that if you're investing these huge amounts of money, there has to be a really clear and transparent procedure and also democratic basis for that. Gets even more tricky when you're talking about government debt, right? And I think a reason why the ECB relies so strongly on private credit ratings going into the Eurozone crisis, even if that became a cause of the Eurozone crisis, was out of a fear to be making that choice itself, right? Which member states are still solvent. So again, there, I think part of the story at least has to be political. But yes, I think part of the story of internal credit ratings is also that you use them to decide which assets you would purchase for the CSPP and related private sector asset purchase programs. For government debt, you probably need a slightly different political solution.
Brilliant. Yes, we're a bit over time. If that's okay for you, we can still 5 more minutes of your time. So I will still let Franz pose his question if he's there. Probably not. Okay, that's fine. A final question then from Noemi Berger. Don't you think that there is a contradiction between the incentive for the ECB to remain neutral and its wish to impulse the transition to a climate-friendly financial system?
Yeah, no, I agree. So there's just a tension between these two objectives. I think you should give up on neutrality. I think you just do away with market neutrality. I think it's a mistake to think that as a public sector policy making, your aim should be neutrality. Rather, your aim should be to shape financial markets in line with your economic policy objectives. And I think that this tension, this contradiction, can be resolved if, instead of trying to be neutral, you try to get a really clear political mandate for the choices that you do make, right? So there is no idea that economic policy in general should be neutral. Rather, in the absence of strong policy reasons, you should, of course, not unduly privilege certain counterparties, right? And the example I already mentioned would be very undesirable if board members benefit companies owned by friends, right? So I think they're part of where neutrality comes from is just an idea of fairness. And I think rather than avoiding making choices, you need political input, you need a transparent procedure, you need a much more clear basis of legitimacy to make choices that go against market neutrality.
Great, thank you, Jens. So let me close here the event. Let me, before closing, remind you about the next event. So next week, we will have Benoit Maujon, who is the head of economic analysis, monetary and economic department at BIS, the Bank of International Settlements. He will give a talk entitled Green Bonds and Carbon Emissions, Exploring the Case for a Rating System at the Firm Level. So the webinar will take place earlier than usual. It will be at 9:30 a.m. in the US and 3:30 p.m. in Central Europe. This ends our event today. So thank you very much, Jens, for being with us once again.
Yeah, thank you for inviting me, for moderating, and thank everybody for their questions and your time.
Great. Till next time.